Okay, let's unpack this. Today we're diving into the pretty phenomenal Q3 2025 results from On Holding AG.
Yeah, phenomenal is the word. This really shows the impact of that premium strategy they're running. I mean, a 65.7% gross margin, that's huge.
Absolutely. It feels like validation for their whole vision, right? To be the most premium global sportswear brand.
Exactly.
So we'll look at the key numbers, that explosive growth we're seeing in Asia, and, the strategic bets that seem to be paying off big time.
Let's get into it.
Okay, so looking at Q3, the period ending September 30th, 2025, the headline number looks good. Reported net sales hit CHF 794.4 million. That's up almost 25% year over year.
It is good, but you always have to look under the hood a bit, especially with currency fluctuations these days.
Right, you always tell us that. So what's the constant currency picture?
Well, that's where you see the real strength. On a constant currency basis, growth was actually 34.5%.
Wow, so nearly 10 percentage points higher.
Exactly. That tells you the underlying demand from customers. Globally, it's incredibly strong. It's not just FX noise. This is volume. It's pricing power.
And speaking of pricing power, let's talk profit. That record gross profit margin, 65.7%, up 510 basis points. Now, a basis point, for anyone listening, is just 1/100%. That kind of margin is pretty rare in this industry.
It really is.
But is it, fully sustainable at that level, or was there maybe a bit of a temporary boost in there?
That's the key question, always. And look, the core strength is definitely structural. They're getting better margins from their direct-to-consumer channel. That share is increasing,
Okay.
and they're getting economies of scale. But you're right, that 65.7% did include a one-off positive adjustment.
About 200 basis points worth.
Okay. What was behind that one-off?
It was mainly freight and logistics costs from the first half of the year. They quite prudently accrued for those costs at a higher rate.
When the actual costs came in lower, they released those accruals. That gave Q3 margins a bump. But, and this is important, even if you take out those 200 points, the underlying margin is still fantastic, still way above their long-term targets.
Right. So strong core performance shining through, and that obviously flowed down the P&L. Adjusted EBITDA margin hit 22.6%. Can you quickly remind us what adjusted EBITDA shows for a company like On?
Yeah, sure. It's useful because it strips out things like one-off restructuring costs or maybe heavy stock compensation, gives you a cleaner look at the core operational cash generation.
Got it.
And in On's case, that core performance is just excellent. Adjusted EBITDA itself surged almost 50% year over year, hit nearly CHF 180 million.
Which explains that huge stock jump, right? Almost 25% after the announcement.
Absolutely. The market saw that underlying strength and, the confidence in the strategy.
Okay, financials are solid. Let's talk geography. Where is this demand actually coming from? Because the growth isn't even everywhere.
No, it definitely isn't. The real standout, the engine right now, is Asia Pacific, APAC. It's just explosive growth.
Explosive is definitely the word. Fourth straight quarter of triple-digit constant currency growth, 109.2%.
Yeah, fourth consecutive quarter. It's extraordinary. Net sales there hit, CHF 144.9 million. So APAC is getting close to being 20% of their total business now.
That's a massive shift.
It is. And the anecdotes they shared, they almost tell the story better. Like the new store in Ginza, Tokyo. Highest monthly sales of any store in their entire network in October.
Wow.
But then, get this. The first store they opened in Bangkok, it had the highest daily sales in the company's history. Ever.
That's insane. It sounds less like market penetration and more like just trying to keep up with demand across China, Korea, Southeast Asia.
That's exactly the picture. It's a stampede.
Okay, so compare that firecracker growth in APAC to the Americas. It's obviously a more mature market for them. Still, 21% constant currency growth is nothing to sneeze at.
Right. And what's really interesting there strategically is why it's strong.
Go on.
It shows that their premium strategy holds up even when they push prices. They actually put through price increases in the U.S. during the quarter.
Oh, all right.
And demand held strong. They aren't relying on discounts to shift products. People are paying the premium because they value the brand and the tech.
That speaks volumes about the brand equity they've built. And it ties into their channel strategy too, right? Direct-to-consumer, DTC, grew way faster than wholesale, 37.5% constant currency.
Yeah, that's a deliberate strategic push. Two main reasons. First, DTC gives them better margins, helps support that high overall GPM we talked about. Second, their data shows that customers who shop across channels, both DTC and wholesale, have a much higher lifetime value. But importantly, they're not starving their retail partners. Wholesale still grew over 32% constant currency.
So key accounts are still seeing strong demand too. It's growth across the board, just
Yeah.
weighted towards DTC.
Precisely.
Okay, let's shift from where they sell to what they sell. Product mix. Footwear is still the core, obviously. Grew a strong 30.4%.
Yeah, footwear's the foundation, and they keep that engine running with this athlete-first innovation focus. You need that performance credibility.
Like Helen Obiri winning the New York Marathon, breaking the record in their Cloud Boom Strike light spray shoes. That's pretty direct validation.
Absolutely. That's proof right there on the biggest stage. Performance confirmed.
And that elite tech, like light spray, it eventually trickles down to us regular runners, right?
That's the model.
Yeah.
And the sources say that specific light spray tech, the stuff the elites are using now, is set to launch for consumers in the light spray Cloud Monster Hyper.
When can we expect that?
Looks like spring-summer 2026 season. So that cycle elite wins, then consumer launch is key to keeping that premium feel and justifying the price point.
Makes sense. But the really huge diversification story this quarter seems to be apparel. It just went vertical. 100.2% constant currency growth.
Yeah, apparel exploded. And the big operational landmark there, they sold over 1 million units of apparel in the single quarter.
1 million units for the first time ever.
First time ever. That's what really backs up this idea they have, treating apparel almost like a company within the company.
That phrase, company within the company, it sounds like a serious focus. Why is apparel so important for their future, especially margins?
Well, the thinking is it drives high-value growth incrementally. And it should have a really strong margin profile, especially as they push it through DTC and use their new stores to really showcase it.
So it's not just an add-on to the shoes.
Definitely not. It's planned as a second major engine. Oh, and accessories grew even faster proportionally, 160.8% constant currency. So diversification is happening across the board.
Okay, so to keep commanding premium prices, selling 1 million shirts, raising shoe prices, they need more than just tech. They need that cultural cachet, that brand heat.
Exactly. And they're playing that game really well, positioned right at that sweet spot. Sport, fashion, design.
You see the performance side with their first gold at the World Athletics Champs? That locks in the credibility.
Right. And then the cultural side gets a huge boost from things like the Zendaya collaboration, the Cloud Zone Moon shoe. That really lifted their fashion profile.
Yeah, it got a lot of buzz.
And also partnering with music artists like Burna Boy. That connects with younger crowds, taps into that lifestyle vibe, even the tennis scene they're building out. These partnerships really accelerate desirability, especially when you link them to their growing DTC presence.
Okay, let's loop back quickly to that amazing gross profit margin. You mentioned structural drivers like DTC and scale. Are there other operational things helping them sustain that, especially with potential headwinds?
Yeah, they specifically mentioned technology. They're integrating tech, including AI, into their planning and operations to become more agile.
How does that help margins?
Well, think about better demand forecasting, optimizing inventory, making the supply chain more efficient. If you can do that well, using AI, for example, you minimize the need for clearance sales, you manage costs better. That flows directly into protecting those premium margins, even if you face, say, tariff changes or currency swings.
Right, making the whole operation smarter. Okay, so after this huge quarter, no surprise, they raised their guidance for the full year 2025.
Yeah, didn't just meet it, they smashed it and raised the outlook significantly. Full year net sales growth, constant currency, now expected to be 34%. That was up from at least 31%.
Which implies reported sales getting close to CHF 3 billion, right? 2.98 billion.
That's the number. And profitability targets went up too. Gross profit margin now guided to around 62.5%.
Okay.
And adjusted EBITDA margin now guided to above 18.0%. That higher profitability gives them breathing room to handle potential hits from FX or tariffs, while still pouring money back into growth.
And maybe the biggest signal of confidence is the update to their longer-term plan, out to 2026. They initially aimed to double sales by then, implying about a 26% compound annual growth rate, CAGR.
Right. And they're now way ahead of that pace. The new plan, the new expectation, is for the 3-year CAGR from 2023 to 2026 to be at least 30%.
So adding 4 points to that expected average growth rate, that's a big jump in confidence.
It really is. It means they see this momentum continuing, anticipating at least 23% constant currency growth, even in 2026 itself. They believe this isn't just a short-term burst.
So wrapping this up, what's the big picture here? It feels like a company executing incredibly well on a very clear strategy. Fail, be premium.
That's it. They're translating that premium brand identity, backed up by elite athletes, boosted by cultural icons, into just massive sustainable growth, and importantly, expanding margins at the same time.
The execution looks almost flawless right now.
It really does. And what's fascinating to watch going forward is that diversification, specifically apparel, treated as that company within a company. Selling 1 million units in a quarter is a huge proof point.
Yeah.
So given they still think they're massively underpenetrated globally in shoes and apparel, the question I leave you with is this. How long can that non-footwear growth keep ripping at triple-digit rates? And what slice of the pie will apparel and accessories be next time they update us? That's going to be really telling.